Walmart shares plunged 9.2% on August 20th, 2026, after the retail giant reported its slowest U.S. comparable sales growth in 6 years, even though the company beat profit expectations and raised its full-year outlook. Heading into the report, Walmart was already under pressure. The stock had peaked at $134.20 on May 19th, but a disappointing Q1 earnings report on May 21st, where cautious profit guidance and soaring gas prices spooked investors, sent shares down 7.3% in a single day. By mid-August, the stock had recovered to the mid-$110, but investors watched for signs the American consumer was cracking under higher fuel costs. The Q2 numbers that came out on August 20th were a mixed bag. On the bottom line, Walmart delivered, earnings beat expectations, and management raised its full-year outlook. But the metric that matters most to Walmart investors, U.S. comparable sales, or comps, grew just 2.6%, below Wall Street's expectations, and the slowest pace in 6 years. Management acknowledged that customers were making trade-offs in their spending as gasoline prices squeezed household budgets. The market's reaction was brutal. Shares fell 9.2% on the day, closing at $103.84, and slid further to $103.70 the next session. In 2 days, Walmart lost roughly $89 billion in market value, and the stock Saturday 22.7% below its May peak, its worst stretch in years. JP Morgan analysts even came out the next day recommending investors buy the dip, but the selling continued. Now, why would a stock crash when a company beats earnings and raises guidance? The answer comes down to what guidance actually is. When a company raises its full-year outlook, that's usually good news. But the market doesn't just look at the number, it looks at why the number went up. Walmart's profit beat wasn't driven by surging sales. It was driven by cost cuts and operational efficiency. When investors saw same-store sales slowing sharply, the profit beat felt less like strength and more like a one-off cushion. Second, the comps number is a direct window into consumer health. Comparable sales strip out the noise of new store openings and closures. They tell you whether existing Walmart customers are spending more or less. A 2.6% comp is still growth, but it's a dramatic deceleration. And when the largest retailer in America, a company that competes on low prices, reports slowing sales growth, that's a signal that spending fatigue is spreading broadly. Gasoline prices were the cited culprit, but the market read it as, if Walmart shoppers are pulling back, everyone else probably is too. The raised guidance actually made things worse in a subtle way. Management was telling the market, we'll still hit our profit targets despite this slowdown. That sounds reassuring, but it also implies the comp miss wasn't a temporary blip. It was something the company was planning around. If the slowdown were a one-quarter wobble, you'd expect management to hold guidance and say, wait and see. Raising guidance while acknowledging weaker sales suggests they expect the consumer squeeze to persist, and they're compensating with cost discipline rather than expecting a demand rebound. So the market's calculus on August 20th was simple. Walmart beat on profit, but that profit was powered by internal efficiency, not customer demand. The demand engine is slowing, and the company raised guidance while confirming it expects no demand rebound anytime soon. For a stock that had run up significantly over the past year, that was enough to trigger a massive repricing. As of August 21st, Walmart sits at $103.70, down 22.7% from its May peak. The question hanging over the stock is no longer about Walmart's execution. The company is running well. It's about the American consumer. Whether the 2.6% comp is a one-quarter wobble or the start of a sustained pullback remains unresolved. The raised guidance now carries the burden of proving the profit engine can keep running even if the sales engine keeps slowing. The next quarterly report is the market's first chance to test that.